Hi all, a very warm evening to all. So I'm Krishna Priya and it's my absolute pleasure to welcome you all to the Financial Literacy webinar series. Today marks the beginning of an excited journey where we will explore the skills, tools and knowledge needed to make smart financial choices that can truly shape our future with a special focus on personal finance management, the foundation for building financial confidence and long-term stability. We are really honored to begin the series with our remarkable speaker, Ms. Preeti Chauhan. So, Preeti is a mechanical engineer by training and has built an inspiring career in the field of finance. After completing her master's in operations research at Columbia University, New York, she worked with PricewaterhouseCoopers in New York and Seattle, specializing in financial risk management. Today, she is the founder of MPower Girls India, an initiative dedicated to empowering individuals with the art of making informed financial decisions. With her unique blend of technical background, global experience, and passion for teaching, Preeti brings a wealth of knowledge to this session. So let's give a very warm welcome to Ms. Preeti Chauhan. I'm certain her insight will help us all view financial management in a more practical and empowering way. So over to you, Preeti.
Thank you, Krishna Priya. My God, I better live up to this amazing introduction. I should record it and share it with my children. Listen to this. All
Thank you.
right. Thank you. So, do I have access to share now? Yeah, one
Yes,
second.
I
One,
hope that you'll be able to share now.
let me see.
Sure.
It says host and panelists. Yeah. Can you switch it to multiple panelists can share?
Yes.
Sure,
So,
sure.
KP, why don't you make Preeti a host?
Yeah, so
uh,
already Preeti is a co-host. As of now, I
Yeah.
have made it as multiple participants.
I'm not sure why I'm not getting this. Usually it just shows up in share. I'm sorry.
No
Sorry, guys.
worries. Um, why let's
Mm. My
make
technical expertise is being challenged here. Okay. I got it. Got
got it.
it.
On.
It's working. Let's do that. Is it full screen on your computers, or is it just like a small window?
No, not full screen.
No.
Can
It's
have
not a full screen? Okay, one second. Ah, apologize, you guys.
yes, now it is.
It is?
Yes, yes.
Sure. Could
Yes.
only- All right. Okay, one second. Woo! Sorry. Some things are going wrong. Here. Okay. One second. I just want to get out of this. I apologize.
No worries, you can just switch that off and then yes.
I am going to try again. All right. Give me one second. I will stop the sharing and fix this and then just join back. Hang on one second, guys.
Yes, please, no worries.
I
Preeti.
promise it's going to be better after we get started. So.
So good evening, students. Good to see more than 160 students in the call. We are hoping to have some of you joining the call. Please bring your notepads, your pen, pencil, write down the questions that you have, and feel free to put your questions in the Q&A box, post the session, or just raise your hands. If time permits, we will be answering to your questions, or you can just drop the note. And if not today, we will definitely come back with the responses before the next session. So any questions around your personal finance management, any queries around taxes and anything that you have mentioned in the Google form that we've shared, please put them together and feel free to ask.
Okay. Think we should work now. One second. All right. Haha. How does that look, everyone? Yes? No?
Looks good.
Okay.
It's just that we can see the small windows on the left, but that's fine.
Why don't we minimize this? Is there any way we can get rid of? How about that? Is that better now?
It's still not full screen, but that's fine. I think Preeti, we can.
How's this?
All good.
Yeah.
Now this is perfect.
Okay. All right. Big round of applause for me to get the PowerPoint presentation sorted. I'm very happy to be here, and I'm looking forward to doing this session with a new bunch of students. We've done this with the previous year of final year students with FFE last year, and I'm glad that I'm able to do this for you guys as well. So the reason why FFE actually wants you all to go through this is because, you're soon going to become earning adults, and some of you, I think, are already FFE alums, so you're already earning maybe. This will not give you exact things like, oh, invest in this stock or specific things to take home, but it will give you a very good broad picture about how you should manage your finances as you grow older. And it's not just for you as a new earner, but things that you should keep in mind as you grow older. All right. There's a lot of topics to cover, and I have wasted a good 10 minutes. So we will rush through the introduction part. All right. Please save your questions. We'll try and answer them at the end of the session. Okay. All right. So first and foremost is having a financial goal. All right. I often like to use the example of when you were, let's say, in your 11th and 12th grade, whether you were preparing for engineering or medicine or any competitive exam, you had these goals in your mind, like, oh, by like with a time frame, right? So, oh, by March I'll finish these number of chapters really well, and then
Preeti, I think there's you got muted.
can you guys hear me?
Yes, now we can. Oh, there's again a mute.
Can you hear me?
Yes.
I guess.
I am not doing anything. I don't know why it's getting muted.
Right.
All right. I'll keep clicking unmute. No worries. So going back to our goals, when you were younger, you had these goals about studies, etc., and you set time frames to it. And lo and behold, you got into a good engineering college or a good medical college, and you're off on your careers. In the same way, when you want to develop a good financial base, you need to have certain financial goals in mind. Okay. And these goals can be actually, there are mainly two types, right? The short term and the long term goals. But we also have this medium term, which sort of bridges the gap between the short and long term. All right. When I say short term, I mean goals that you can achieve within the next 1 year, 2 years, 3 years, right? And then when I mean long term, these are goals that are usually what you're planning for your future, like which is far, far away. For you guys who are in your early 20s, retirement seems far away. Your children's education seems far away. So those are some of the long-term goals for you right now. But in the medium term, for example, yes, you've saved up for a vacation, or you've bought a fancy phone, but now there's other things that you want to do in the meantime, right? Let's say you want to go and do an MBA, or you want to buy a car, or your sister or brother or you are planning your own wedding. So everything involves money, right? So those are like medium term goals, which is not right away in the near future, but you still have to plan for it. And then our long term goals. The reason why having these goals in mind is important because it gives you focus, not only in terms of trying to do better at earning money. I mean, by trying to go for the promotion or go and try a different job if you're not happy, or trying to spend a little wisely instead of being very open fisted, right? So all these things will give you a direction and a focus. So having a goal, a financial goal in mind is extremely important. All right. So I want you all you don't have to share it with anybody, but just keep it in mind, make a list of these goals. How do you imagine? Maybe your goals are not just for yourself, but even for your family. You say, I am going to make sure my parents' retirement is taken care of, that they never have to worry about anything else. They've put me through college. Now I'm going to take care of them, whatever it may be. So you need to have this goal in mind, and that will really help you in the future. All right. So make a list of your short term, long term goals. If you have a pen and paper, write it down as we go along. You will see the things that we are discussing. Always come back to this financial goal. Okay. Moving on. Next. If I can move to the next slide. Ah, yeah. Now, when we again going back to financial base, what is it really made of, right? We can talk about investments, we can talk about big things, but the basis of it is our income. Like if we don't have an income or a solid, steady income, then all these plans are, just pipe dreams, right? So our income, a steady income is like the basis, the foundation of this financial base. All right. I like to compare it again with a house. So if you have a beautiful house, but its foundation, it's very pretty from the outside, it has beautiful paint, wonderful gate, garden. But if the foundation itself is not strong, then your house is as good as, it's no good, right? So your income is the foundation of your financial base. The next thing is your savings and investment. Everything else, whatever you plan for your future, even if it's a small thing like a weekend trip or going to a restaurant, or if a bigger thing like, I'm going to plan for my retirement, something like that. Everything involves savings and investments. And we'll get into the difference in what you need to use when later on. But these are like the bricks and walls of your house. You have the strong foundation. Now you have these savings that you have made, which will help you weather any storms, right? Like you have an emergency, there's a medical emergency in your family. Okay, I have some savings I can rely on. Oh, there's, a wedding that needs to be planned. Okay, I have some investments which I can, liquidate and use that money for that, right? So these are your strong walls and your ceiling, which help you get your goal, get to your financial goals. Yeah. And the last but not the least is your smart spending or your spending habits. Uh, a house can be very strong if it has only walls and a ceiling, but that's a box. It's not a house. You need to have windows, you need to have doors, you need to be able to look outside, you need to be able to let the wind come in, right? You need to enjoy that house. So spending is like that. You need to have the money, you have the money, and you should spend it to enjoy it, to see what joy it can bring you. But you must be mindful that if I suddenly replace all my walls with huge windows, which is equal to large spending, or big, tall doors, then I have more outflow, many more things. And my house is getting weaker. The walls have become weaker, right? So while you want to spend money, you have to be smart about it. How much do you want to spend? And um, within certain limits. All right. So these three things we'll focus on, and in each we'll go into a little more detail. Um, 1 second. So yeah, there we go. We have income, smart spending, savings and investment. And then I'm just going to cover insurance and debt and repayment really quickly at the end. But we'll be focusing on the top three in much more detail. All right. So first things, income. And in income, we're going to talk about these two important things, which is understanding your paycheck and taxation, which is a very fun topic. All right. So let's start with understanding your paycheck. Now, I'm going to have a little bit of technical issue because I'm going to be copying this link. Let me see. And I have to share this with you. I'm going to try to do that. All right. Can you see this? Somebody give me, Taruna, just let me know if you can
Yeah.
see the
So,
screen.
Preeti, we are able to see the LinkedIn icon as of now.
Yeah,
It's
yeah.
loading. All right.
Yeah, it's loading. I hope it works. Yes. Okay. So this is the video I want to show. Let's hope it plays.
That will be my CTC. How much after deductions?
All right. So that video sort of gives you a glimpse into what this CTC eventually comes down to, but it is not as bad as this makes it look. Let me just go back to our slideshow. Oh, yep. All right. So as you can see, the CTC is it stands for cost to company. It's the big number that is quoted to you when you're given an offer, right? This is the total cost that a company spends on you in 1 year, all right? The next important thing for you to know is what is your gross salary. Why is gross salary important? Because that is really the cash component or the actual money that comes that you see or that you get your hands on. Because in your CTC, there are other things which are hidden, which is, for example, your employer's contribution to the EPF, gratuity payments, etc. So when you remove those, then you reach the gross salary figure. And then from the gross salary, once you have made your contribution to EPF, or your tax has been deducted, or other insurance and professional tax has been deducted, then what remains is your net salary. This is the money that you finally have in your hand. And then with this money, you can decide whether you want to pay your rent, pay your electricity, you want to invest, you want to go shopping, whatever you want to do. All right. So I'll just go into detail with everything. So don't worry. So CTC, like I said, is made up of two things: your monetary compensation, which is like your basic salary, your HRA, LTA, your bonus, commission, whatever, however this is structured by the company. But this is the cash component that you get. All right. And then there is this indirect compensation, which the company does, but they put a money value to all of this and they include it in the CTC. So let's say your health insurance, if it pays, if you have paid leave, if they're making any gratuity contributions and the EPF contributions, all that money will be added to this cash component that you get in your hand, and that is added, and that makes up a big CTC number. That's why when you think, oh, somebody offers you 12 lakh CTC, it doesn't mean that you're going to get 1 lakh a month, right? It's much less than that. Okay, so in indirect compensation, there's other things like your perks. Suppose your company offers you transport services. It offers you meals or a mobile plan. Even that they will monetize. They will put a money amount to it and add to the gross income. All right. And now this interesting thing called ESOPs. This is for companies, for startups mainly. So this is a very nice way for them to say, we are giving you shares, and the shares we think are worth X number of lakhs. So your actual cash component of your salary may be less, but your ESOPs might sound like it is a lot. They might say, oh, you will get 10 lakhs ESOP. So you go home, running home and say, oh my God, I got, let's say your 8 lakhs plus 10 lakhs, 18 lakhs CTC. But in truth, that ESOP value has many things that has many stages in which it finally comes to your hand. The first and most important is your cliff period. So every startup will not hand out those stock options to you right away. They'll say, I want to make sure you are dedicated to my startup. And so they'll say that this, whatever X number of stocks that you'll get a chance to buy, or you'll get them, will come after this cliff period of 3 years. So you have to work for 3 years, or maybe 2 years, or maybe 1 year. That cliff period, it depends on the company. All right. So they say, let's say it's 1 year. You will get these stocks at the end of 1 year. Now they say you are going to get 100 stock options, right? You have this option of buying 100. But they'll say, but this will vest over a period of 3 years. So 33.33 you will get in the next 3 years. So you've spent 1 year in the cliff period waiting to get these stocks. Then they'll say but you cannot sell it, or but you cannot cash it. You have to wait for 3 years. Well, only one third you can. So a lot of numbers are added to your CTC to make it look bigger, but you, as a very smart engineer or a doctor or lawyer, need to know what it actually means and what you will actually get in your hand. Because at the end of the day, what you get in your hand is what you're going to use for all the important financial decisions, right? All right. This is an important thing, and it's a good thing which companies actually invest. It's a retirement fund, if you think about it. I know it's too early for you, but to be honest, it is never too early to start thinking about your retirement. And the earlier you start thinking about your retirement, the more benefits you will reap as you grow older. All right. And this will get clearer later. All right. So EPF stands for Employee Provident Fund. The employer and employee both contribute to this fund. So the employer's contribution is 12% of your basic, and your contribution is also 12% of your basic. Now the employer's contribution, this part, becomes part of the CTC. You will never see this money till you finally withdraw funds. All right. So the company will contribute this much, 12% of your basic salary, towards EPF on your behalf. And you will do it on your own. But this part, the employer's contribution, becomes part of the CTC and not in your in-hand salary. Save your questions. I can see a lot of hands being raised. Please save your questions. I will get to them in the end. All right. Now getting to your gross salary. So you got your CTC, that big number. From that, if you subtract whatever the employer contributes towards EPF, which was the previous slide, gratuity, and the superannuation fund. The second one, the superannuation fund, is not mandatory, by the way, even for companies to do, but gratuity is. All right. So gratuity is, if you think about it, a way for a company to show their gratitude to an employee who has worked there for a long time. And you can only get this gratuity if you have worked at a place for 5 years. So you quit at 4 years, 11 months, I'm sorry, you will not get any gratuity. All right. So they are going to be making these gratuity payments on your behalf right from day one, or they will claim to do it, and they owe it to you only if you work there for 5+ years. And there's a formula how they calculate it. It is whatever your last drawn salary is multiplied by the number of working years. And then interesting fraction, 15 by 36. 15 is the number of days per year that they want to pay you for. And 26 is the working days per month. So 15 divided by 26 times last drawn salary and number of working years. Now, whatever this gratuity you get is tax-free up to 20 lakhs. So suppose after calculating all this formula, you worked somewhere for 15 years and then this comes up to 20 lakhs. You don't have to pay taxes on this. It becomes free, tax-free money. All right. Now, superannuation fund is similar, but basically the company again contributes towards, this is only 15, up to a maximum of 15% of basic salary. You do not have to contribute as an employee, but you can withdraw some amount of it tax-free at about 25%. The remaining comes to you like a monthly paycheck, like an annuity, like a guaranteed income after your retirement. But don't worry too much about that. Not all companies do the superannuation fund. They do it, and hence I've mentioned, but EPF and gratuity, you can understand clearly. That would be good. All right. These two, again, are part of your CTC. When you subtract that from CTC, you get your gross salary. All right. Now, what's our net salary? What is it that you get in your hand? Again, now it's your turn to contribute. You've got the cash from the company. Now, from here, you are required to contribute to EPF. There goes 12% of your basic. Then you have to, some tax will be deducted from this, will be deducted by your company right away. So that goes away. Then some health insurance or professional tax, those deductions go away, and then you are left with your net salary. All right. Now, the quick way or a back of the envelope way of calculating how much your monthly in-hand salary will be from your CTC is this. It's not exact, but it's a very good approximation. So suppose your company gives you a CTC of less than 10 lakhs per annum. Then you divide that number by 13 or 14, and that will give you an approximate idea of your monthly in-hand salary. So let's say in this example that I've used, someone gets 9 lakhs CTC. Dividing it by 13 would give me about 70K per month. Dividing it by 14 gives me 65K in hand. This is the money now I can use to spend, to invest, to save. This is my in-hand money, in-hand salary. All right. The second part is, if your salary is greater than 10 lakhs, let's say it's 12 lakhs per annum, then you divide that number by 15. And your monthly, then you get an approximate value of your monthly in-hand salary. So whenever you get an offer, you can quickly do this back of the envelope calculation and see, okay, this actually means that I'm only going to be getting 65,000 rupees per month. Is that enough for me? Is that good? Oh yeah, that's wonderful. It's more than what I imagined. Oh, it's not good enough. I'm the topper. I should be getting a lot more. So it will sort of help you in your negotiations. Good luck. All right. So that's that. All right. Now I want to introduce you to this person called Arya. I had a very tough time choosing a name because I didn't want to choose a boy's name or a girl's name. So I said, let me think of a name which can be a girl or a boy. So I thought I was very smart in choosing Arya as the name. So Arya is 24 and he or she has just got their first job in Bangalore. Their annual CTC is 8 lakhs. Can someone help me put up the poll, Taruna? I'm not sure if I can do
Yeah,
this.
sure, Preeti. I
Yeah.
can read you with it.
Yeah, thank you. So the first question, guys, is what is Arya's approximate monthly in-hand salary? So the CTC is 8 lakhs. What do you think is the monthly approximate? Don't worry, it doesn't have to be exact. Can you guys quickly use the poll and
Yes, scholars, I hope you are able to see the screen for the poll. Could you please vote in the poll and answer for the question? Yeah, Preeti, we are getting few answers.
yeah. We'll just wait. Well, let's just we have a lot of participants, so we'll
Sure, we'll wait.
wait.
Scholars, please quickly answer in the poll. Yeah, thank you.
Yeah. All right. I think most of you are getting the right number. Yep. So it's going to be somewhere around 60K. Yes, very good. So if you divide it by 13, then you get 61. If you divide it by 14, you will get like 57 or 58, right? So that's great. Thank you. We can close this one. So everybody gets an idea that how from 8 lakhs, we come to in-hand salary of approximately 60K. All right. Let me shut this. I'm just going to close this and I'll ask you for your help again later. Yeah.
Sure.
All right. Great. Oops, sorry. So that was our understanding of our paycheck. So you got a CTC package of 8 lakhs. You calculate what your back of the envelope in net salary is about 60,000 rupees per month. All right. Now we'll move on to our wonderful topic of taxation. All right. Income tax is not everyone's favorite thing in the world, but I think we are fortunate if we are fortunate that we are capable enough, that we are earning enough, that we have to pay income taxes. So I don't think we should, like complain about it. It's to be honest, an honor, right? Like you're doing something, you're paying taxes. It's going to be used, hopefully, to fix Bangalore roads, hopefully to improve infrastructure in the country, and this is our little contribution to our nation. So do it, everyone who has a taxable income needs to pay their taxes. All right. After that gyan, now let me get on to details. So I just want to go over some key terms which, as you begin to pay taxes next year or this year for the ones who are already earning, it'll be helpful. All right. So as we all know, the tax year begins 1st of April and goes to the next year, 31st of March, right? This is known as the previous year. So last year, 1st April to this year, to 31st March, this year is known as the previous year. Now assume that now I'm where I am in September, right? So today I have to, this year, right now is now my assessment year. So basically the next year, which is, let's say this was, previous year was 2019, 2020. Then the assessment year is 2020, 21. In this year, I will assess or calculate what my taxes are and I will file my income tax return. All right. So previous year is the year where you earn the money, and this year, or the assessment year, is the year when you pay the money. All right. Now, the next one is heads of income. Basically, you can get income from many sources. What the income tax department wants is that you add up all the income from all these sources and put it together. All right. So this income could be from your salary or pension, from your banks, or your, if you get interest, any interest that you have received on your savings account, FDs, etc. Any capital gains, these are gains on, let's say, sale of stocks, sale of mutual funds, sale of house or property. Yeah. The next one is income from house property, which is the rent you're earning. Let's say you have a house or a room that you've rented out and you're earning money from there. That also you have to add up. And then the last is if you have a business on the side, or you're a businessman, you don't have a salary, right? You're, you own a business. Some months it's high, some months it's less. So basically you put everything together, and these are the heads of income. When you put them all together, you come up with this number called the total or gross income. All right. This is, you add up all the heads of income. This is your total income. But don't worry, this is not the amount on which you have to pay your taxes. All right. What you need to pay your taxes on is known as your taxable income. So the government also helps you reduce your taxable income by giving you the option of deductions. All right, which there's a very complicated slide on the next slide I'll show you. So basically, if you make any deductions from your total income or your gross income, then you reach the amount on which your tax needs to be calculated. That's your taxable income. All right. This brings down the deductions help to bring down your taxable income, and therefore your tax liability also goes down. All right. TDS, I'm sure you've heard before, is tax deducted at source. This could be your employer deducting tax or your bank deducting tax on the interest right away, etc. So this is TDS. All right. This is the slide that I was talking about when I said deductions. So you have these different sections, section 80C, 80G, 80E. There's a whole bunch of them. So basically, any investment, 80C is any investment in EPF. So the 12% in your basic that you put into your EPF can be deducted from your gross income. All right. So that makes your taxable income smaller. Let's say you make some donations to charitable organizations. That amount can also be used as a deduction. Now, depending on the organization, you can deduct 100%. If you donated 10,000 rupees, you can deduct 10,000 rupees. Or sometimes the government is a bit picky now. They say you can only deduct 50% of that charitable donation. 80E I have highlighted is because suppose some of you go for higher education and you take an education loan, then the interest that you pay on this loan, not the principal, the interest can be used as a deduction, and there's no limit on this amount. On the interest that you are deducting, you cannot use the principal. All right. So these are just some deductions that you can use. But these were very commonly used in what is known as the old tax regime. All right. The new tax regime is what we are going to focus on now. So as you can see, there's like the old tax regime is on the right-hand side of this little bright red graph. You can see the tax slabs in this. What do we mean by tax slabs? So whatever your taxable income that you finally get, which slab does it end up in? Is it between 0 to 4 lakhs, 4 to 8 lakhs, 8 to 12 lakhs? Where does it fall, right? Your final total taxable income. In the old regime, as you can see, there were only 4 brackets, like 4 income brackets, 0 to 2.5, 2.5 to 5, 5 to 10, and everybody above 10 lakhs had to pay 30% tax. That seemed a little unfair because if I'm earning 11 lakhs versus I'm earning 1 crore, that 30% for me matters a lot more if I'm earning 11 lakhs. Like a person who's earning 1 crore is already doing so well that 30% for him or her it matters, but it's okay. But for someone who has just crossed that 10 lakh border or who's earning 12 lakhs, then that 30% would hurt. So what they've done in the new tax regime is they've added a whole bunch of slabs, 0 to 4, 4 to 8, 8 to 12, 12 to 16, 16 to 20, as you can see, 20, and then the final 30% and above comes above 24 lakhs taxable income. All right. So this basically, and then they've sort of reduced these rates as well. So 5%, 10%, 15, and then they've sort of spread it out a little better. The reason for doing this is that, they honestly, the government wants middle class to spend money to help our economy do better. They don't want you to be like, oh my God, I have nothing left to spend, or I have nothing left to save or invest. So by reducing the tax burden, they're encouraging this. All right. And the other good thing about the new tax regime is that they have given a huge exemption. Basically, if your income is up to 12 lakhs, there is a section called Section 87A, which allows, actually, it's on the next slide. Let me just move to the next slide. Yeah. This is a comparison of the old and the new tax regime. You can make a choice of choosing the old regime when you pay your taxes, but basically now the default is if you have not gone and told that, oh no, I want my tax to be calculated using the old tax regime, the default setting is new tax regime for everyone. All right. There's a standard deduction for everyone. You don't need to provide any paperwork for this. This used to be 50,000 for salaried and pensioners, salaried people and pensioners. Now that has been increased to 75,000. All right. Your tax rebate, this is the section that 87A that I was talking about. Basically, earlier, if your income was up to 5 lakhs, when you calculated your taxes based on this formula, 0 to 2.5 was nil, and 2.5 to 5, this is another 2.5 lakhs, 5% of that would give us 12,500. Basically, that was given up as a rebate. Like, you don't have to pay any taxes. What they've done now is the tax that you would have to pay for 12 lakhs of income using the new regime, going back here. So for the first 4 lakhs, you pay zero tax. For the next 4 lakhs, you pay 5%. And then for the next 4, you pay 10. So this is 40,000 here, and this is 20,000. When you add those up, you get 60,000 tax that is due to the government. What the government has said is that don't worry, if your tax is up to 60,000, you don't have to pay it. Get it? So if your income is up to 12 lakhs, you do not owe taxes. All right. So earlier, a lot of deductions were allowed in the old tax regime. Now, all those deductions in that ATC, the charitable contribution, etc., they are not allowed. The only thing which is allowed is the National Pension Scheme contribution. All right. That's the only one. Now, the old tax regime is beneficial for those who have a large number of deductions. There's a chart you can find online where it shows that if you are earning 8 lakhs and your deductions come up to like 2.5 lakhs, then you should go with the old tax regime. But if your deductions are not that high, then just stick to the new tax regime. All right. So those earning up to 12 lakhs should just opt for the new tax regime. Here's a new poll, and it's a very easy one. I don't think anybody needs to really answer this because I've been harping about it, but let's just do it to see how many of you have been paying attention. Can I have the next poll, please? So Arya, remember, who's 24 and earns a CTC of 8 lakhs. The thing is that Arya has decided he or she doesn't have any major deductions. This is the second question, people. Let's go to the question number 2. Yeah. Which regime should Arya opt for, the new regime or the old regime? There we go. The first answer is correct, and I hope everybody, yeah. All right. I think most of you get it. Don't worry. I'm just going to, yeah, excellent, excellent. Everybody gets it. Most of you get it. Like, guys, you don't have to use the old tax regime because Arya has no major deductions. All right. So please stick with the new tax regime because her or his income is under that 12 lakh number. All right. Great. Let me just move this, closing that. Okay, so now Arya is going to use the new tax regime to pay taxes. How do you now wonderfully calculate your tax? How much tax do you have to pay? So you gather up all your income. If you're using the old regime, use the deductions. You come up with the taxable income, figure out which tax slab you need to use to determine your tax, and then see if any TDS has been cut. If not, then add that amount to the amount that you are going to pay. I would highly recommend you to use, especially if your income is above 12, etc. Please use advanced tax. Otherwise, you may have to pay some interest charges. This is like 4 times a year they allow you to pay advanced taxes for every quarter if you think about it. All right. Yeah. Okay. Next. Let's go back to Arya again. So Arya's CTC is 8 lakhs. he or she has decided they're going to go with the new tax regime. Let's see how Arya's tax is going to be calculated. So first step is you come up with your gross salary or your gross income. Okay, so CTC, you subtract the provident fund, gratuity, superannuation. I've just come up with this number based on like 12% EPF and some gratuity and some. Don't worry about this number. The gross salary is about 6,56,000. All right. Now we said, we are not going to do we are going to follow the new regime. So she or he does not have too many deductions, but the one standard deduction everyone is allowed is that 75,000. So what's my taxable income? 6,56,000 minus 75,000. All right. So it comes out to about 5,81,000. Now we look at the tax slabs. So for the first 4 lakhs, there is no tax to be paid. Great. For the next 1,81,000, I have to pay at the rate of 5%. So my tax liability is actually 9,050 rupees. But guess what? That wonderful section 87A allows me a rebate of up to 60,000. So honestly, Arya does not need to pay any taxes. But here's another poll. Even though Arya's tax liability is 0, basically no tax needs to be paid, should Arya file the ITR? Let us see. Even though Arya's tax liability is 0, basically tax payable is 0, should he or she file the income tax report? All right, I see some yes, I see some no's. Very good. All right, I think just a few more, please. Yeah. Yeah, all right. That's great. So basically, the answer is yes. Arya, whether or not their tax liability is a 10,000, 20,000, whatever it is, Arya needs to pay it needs to file the income tax report. No tax does not mean no return. I meant the ITR, the income tax return. You need to file it. Why? Because the moment your taxable income is more than the exempted limit. Oops, can I just close this poll, please, for now? Yeah. The moment your gross income or let's say your gross income, not your taxable income, is more than that basic exemption. When we say exemption, it means that amount for which there is no need to pay tax, 0 to 4 lakhs, no need to pay tax. That as soon as you cross that limit, you have to file your ITR. All right. And it's important because it's a legal requirement and it can be used for many things, like as a proof of income when you're applying for loans, and sometimes your employer may deduct TDS because, they have one big tax department and no matter who earns what, they're just deducting tax at source. And even though Arya's tax payable was 9,050, they have eventually over the year deducted, let's say, 20,000. Now Arya needs to get that extra money back. So that refund, in order to claim that refund, it's important that Arya should have filed the ITR. All right. Later on, as Arya starts investing, they have some capital gain or capital loss. These things can also be adjusted. You can offset it in the future. All right. And also, it's very important to have a compliance history, right? Like, yes, the moment I started earning, I started filing my tax returns. So, no tax does not mean no return. Everybody, even though you don't have to pay tax, please file your income tax return. Okay. I think that's it about income. Now we're going to get into smart spending. All right. The main thing in spending is this important thing of knowing the difference between what my needs are and what my wants are. Needs are my essential expenses. Like, I have to spend this money because without this, I cannot survive. And what are my wants? Anything which is not, which is superfluous, like what I need to survive, and anything outside that is a want. All right. The next thing we'll talk about is the budgeting rule and some tips. Okay. Let's get into the needs and wants. All right. Needs, again, like I said, are your basic necessity. It's what they say in Hindi: roti, kapda, and makan. Okay, roti is your food, kapda is your clothing, and makan is your house. But now, of course, times have changed. We need dawai, we need medicine, we need our phone. So some of these things have become part of our needs. And that's okay because times have changed, right? So in the first column, as you can see, your housing, your groceries, and your basic meals, right? I'm not saying you're having biryani every day or you're eating like fancy meals, like what you eat on a regular basis. Your transportation, your commute to work or your commute to college, for example, and then your health insurance or whatever you're paying for your doctor bill, etc. Like if you god forbid you're sick and you need to have medicines and this and that, that becomes a need, right? So these are your needs. Anything beyond that, anything that we want, like we desire it, but they're not necessary for my survival, like my latest phone, or like going out with my friends every weekend, or for to a fancy restaurant, or to just like going to watch movies every so often, or a very expensive gym membership. All these things are very easy to get into a habit of when you, as soon as you start earning, you're like, oh yeah, I've always wanted to join cult. I'm going to join cult. As good as cult is, you can get the same benefits by spending some money on a good running shoe and going running. All right. So you have to think about anything that is over and above your basic necessities. All right. And every time you're out there and making a purchase, I want you to stop and think, is this necessary? Is this necessary and essential for me, or is this a luxury? And guess what? This is where your financial goals will help you. Because if you have a financial goal in mind, every purchase, you should stop and think, is this helping me reach my financial goal? Yes, it is. Oh, wow. Wonderful. Let me go. Go ahead and spend it. No, it's really not helping me reach my financial goal. So, having that goal will help you also sort between these expenses of your needs and your wants. All right. Uh, so, every time you have a purchase coming up, think about it. Is this necessary, or is this just a luxurious thing that I'm spending money on? Okay. Next is our budgeting strategy. So basically, the idea is that once you figure out what my needs are, then you allot about 50% of your income towards that, towards your needs. Or if you have a very good income, then maybe this percentage will be less. Like all your needs, your rent, your groceries, your electricity bill, your phone bill, your transportation costs, everything is covered in less than 50, which is wonderful. But let's put aside 50 for your needs. Then, because we are earning and we want to also enjoy our life to some extent by, spending money or spending time with our friends, going to movies, etc. And these are good things. Please do it. But what we want you to do is to do it in moderation, right? So let's put aside 30%, which is a huge number in my mind, to put for wants. And then 20% you have to put aside every month for your savings and investment. In my opinion, the 20% should happen first. You should put aside the 20% right away for savings. And with whatever is left, the 80% that is left, manage your needs and your wants in that. That way, you're prioritizing your savings and investments. All right. So remember this 50-30-20 rule. And this percentage can be different for different people. But the one thing that you should be sort of rigid about is that put aside at least 20% towards your savings and investment. Okay. Now, some tips for you guys. The best way to sort of keep track of your money is to create a monthly budget. So now let's say whatever money you get, you have this rule in your mind, 50, 20, 30, 50, 30, 20. So you put aside all my expenses, that my rent, my utilities, etc., should come in the 50. I must put aside 20 through SIP or FD or something for my savings, and the remaining 30, if it's 30, great. If I don't want to spend the 30, I can put it towards my savings. Like if I don't want to spend 30% of my monthly income on entertainment, it's totally fine. In fact, I highly encourage you to use that money towards your savings instead of spending it away. All right. So create a monthly budget and track it. See if you're, as you track your expenses, like whatever you spend, like put it down in a diary, in an app, in an Excel spreadsheet, whatever works for you. Put down whatever you spend. I took an Uber today. Oh, shoot, it was 400 rupees versus my metro, which is only 150. Oh, I went out today and I also ordered dessert. So instead of my bill being 500, it became 700. Things like that. Please track your expenses, even the basic ones. That way you will know what you're spending, and at the end of the week or end of the month, whenever you have time, you look at it and say, this is where I need to make my changes. I think I'm going out too often. I think I'm spending too much on clothes or too much on movies. I'm spending way beyond my 30% on my wants. Or some days, some months, you might be like, wow, I did so well. I invested extra this month, right? So that also helps. For any major purchases, please plan for it. Do not go buy anything on impulse, especially on your credit card. Why? Because these credit cards have extremely high interest rates. Like the next point says, it's 22 to 52% APR. Okay. So, if you have used your credit card, please pay it off as quickly as possible. All right. Do not pay an interest on your credit card payments. Don't fall into the trap of that minimum payment required. If you have bought something on credit card, please make sure you pay it off as soon as possible. All right. Avoiding impulse spending is easy if you implement a 24-hour rule. Let's say you go and you find something very exciting and like, yeah, but it's very expensive. So you go back home and you say, I'll come back and buy this tomorrow. Or even if you're at night, you're on Amazon or Myntra or God knows what, you're looking for something and you say, oh, wow, there's this festive offer that is coming, but you don't have the money, right? It's not a necessity. Otherwise, you would have already spent the money on it. So you stop and say, okay, let me come back 24 hours later and see if I really want it. This way, this gives you a chance to stop and think, is this purchase again aligned with my financial goals? Yes, okay, I will go ahead and buy it. No, it is not. Let me not buy it. All right. And please just remember, live within your means, right? There's no glory in having a big credit card debt or credit card bill and showing off to your friends. Nobody is going to pay your credit card bill. That responsibility lies on your shoulders. All right. So there is no point in showing off and spending and trying to be someone that you are not by spending excessive money. Please live within your means and control your spending. All right. Remember Arya? Let's go back to Arya. All right. Now, Arya has this, remember we sort of calculated 60,000 rupees per month money in the hand from that 8 lakhs CTC. All right. So let's say Arya has some bills. Arya has to pay. They've taken this 5 lakh loan. Maybe their parents took this loan, but now Arya is earning. So Arya needs to repay it. And of course, Arya is now earning. So they want to enjoy life. And they also want to start saving for the future. Let's see what Arya's approximate, again, this is approximate, this is a shared apartment. I'm sure 18,000 rupees will not get you a decent place in a metro. So these are the costs, all right, for food, for transportation, for loan EMI, etc. Now, when we add up all these, the top four, which is basically your needs, like your payment of your loan is actually a need, because otherwise that interest will build and it will reflect poorly on your credit score, etc. So you have to pay it. So adding this 30, 13, 6, and 16 gives us 67%. So poor Arya is spending about 67% of her or his monthly income on the needs. Arya is very good about wants. They don't spend too much on entertainment and shopping, only 10%. And the rest, they're saving, Arya is saving up for some travel in the future, for a retirement fund, and for an emergency fund. And I'll tell you what emergency fund is later. All right. So savings is about 24% and wants is about 10, needs is 67. All right. Now I want you to imagine a scenario where Arya works really hard and gets a bonus of 1 lakh. Where do you think this money should go? Should Arya use it to repay this loan, to build an emergency fund? Okay, emergency fund, I need to tell you what that is when you decide to save enough money for 3 to 6 months of your needs, of your money that you need for a month. For example, in this case, it is 18 plus 8 plus 4 plus 10. Let's even exclude the 10. So it's 22 plus about, what is this? My math is going bad. 30,000, right? Rupees. So 30 times 3, which is about, let's say, close to 1 lakh, would be a good emergency fund for Arya to have in case Arya loses her or his job, in case they they need to, their laptop breaks or their phone breaks, something like this backup money where you can rely on that, right? So what should Arya spend this 1 lakh bonus on? To repay this 5 lakh loan, to build an emergency fund, to add to the travel savings, or just go party, man? I've got a bonus. This is like wonderful. My life is good. Let me just go shopping and spend some money on entertainment. Can we have the poll on this, please? Thank you. And again, remember, there is no right or wrong answer. You can choose one, and it could be, 1 second, where is it? Yeah. So Arya has got a bonus of 1 lakh. Arya has loans to pay. Arya still needs to develop the emergency fund, also wants to save up for some travel. Where should this money be going? Spend on entertainment or shopping? Great. Some of you are saying build the emergency fund in one shot. Some are saying repay that debt. No need to have a loan sitting on your head, which is also a good thing to think about. Yeah. Yeah. So I think most of you are on the right track. Spending some of that 1 lakh on entertainment and shopping is also fine. There's not a big deal. But you have to keep your financial goals in mind. I want to be debt free. I don't want to have any loan over my shoulder. I want to have an emergency fund. If I get extra money somehow, let me put it towards those things. That's a much wiser and smarter financial decision. All right. Now I'm going to the next most important thing about, I'm going to shut the polls again. 1 second. Yeah. Which is savings and investment. Okay. In savings, we're going to cover these things: savings tips, goals, how you can use banks or government schemes for saving schemes, etc., and how you can use money for investment. All right. So now let's go and get on with the saving tips. Tip number 1, even if it is a small amount, ideally, I want you guys to save or invest 20% of your monthly income. But let's say your needs are very high that month. like there was a medical emergency and you don't have the money to save. But even if you manage, no matter what, a small amount every month, please save it, put it aside, and make it a habit. All right. In case of emergency, everybody understands, okay, you couldn't save this month, but every month, hopefully your life, you will not be having emergency. So you have to make saving a habit, right? So every month, even if it is a small amount, save it. And like I said, in that 50, 30, and 20 budgeting rule, I want you to consider that 20% of savings as like this urgent bill. Oh my God, I have to pay this bill. It is so urgent. What is urgent is this savings. Like I have to first pay this bill. I have to put 20% aside for my savings, for my investment. And after that, whatever is left, I'm going to use for my needs and wants. So consider this: pay yourself first. You're paying yourself. You are the urgent bill that needs to be paid. This money is for you in the future. All right. Now, this back to the emergency fund that I was talking about earlier. This is 3 to 6 months, ideally 6 months, right? But let's start with at least three. When you start earning, please put aside money on a regular basis to come up with at least 3 months of living expenses, right? So any unexpected costs that you may have to deal with, this money will help you pay for it, right? You start small. You aim for the first, let me have enough money to cover 1 month of expenses, and then gradually you make it 2 months and you put it aside. This you can put aside in like a savings account or something and not even look at it. Like, I don't have this money. Only when an emergency arises, then this money will appear. Otherwise, this money does not exist in my life. Like, be tunnel visioned in this regard. Okay. And my other tip is, before you start investing, like everybody wants to start investing, please build this emergency fund, build this 3 month cushion, and then you can start investing in the stock market. Like, first save this much, prove it to yourself that you have the discipline to save, and then you can go ahead and invest in the stock market. Now, an important thing for you guys who are in your 20s, please start doing this like right now, like when you are young, because the earlier you start, the more benefits you reap of the effect of compounding, right? Even if you put a small amount, like 500 today will mean a lot more than 30,000 rupees when you're like investing 30,000 rupees when you are like in your 40s. All right. 500 today will actually be approximately the same kind of returns. So Warren Buffett's quote is actually very good, because he says, think about your investment or your savings like a snowball, right? So, and you're on the top of this mountain and you make a small snowball, which is the size of your palm, like it fits in your palm. And then you roll it down this snowy mountain. As it goes down, it gathers all this snow, and slowly, by the time it goes down this long hill, it's become a really big ball. The idea is that you already know that you will have a long hill, like, oh, I will have a very long life, I'm going to have so much time to invest. Nobody knows that. Like, life may be short and maybe you don't even need those investments, but you always plan for scenarios which you expect to live till like 85, 90. So you have to start thinking about that right now. You have to start investing and saving when you're young, and then let that benefit you with over the years of compounding. As you grow older, that amount slowly will grow bigger and bigger, and by the time you are actually in need of it and you're no longer earning, that will be substantial. All right. So please start investing early, young, like right now. All right. Now, we're going to go back to our financial goals. Remember the short term and long term goals. So when we think about short-term goals, things that we can achieve or which do not involve a lot of money, uh, we think of them as short-term, right? For the short-term goals, our recommendation is that you go with a low-risk product, which is basically a savings account in a bank or a fixed deposit or a recurring deposit in a bank. These are low risk because all your savings in a bank are sort of insured, right? And this kind of putting money aside is ideal for vacation. Let's say you make a little side account for only vacation savings, or you make it for your emergency fund, or you want that next iPhone or whatever. You say, I'm going to plan this purchase. Whenever it comes out next year, I will buy it, right? So you start saving for it now. I'm not putting ideas in your head, okay, guys? That's just an example, okay? So these are your short-term goals, and for that you use savings. But for your long-term goals, like your retirement planning, for things like your children's education, your children's wedding, whether or not you're married right now, you need to start thinking about all these long term goals as you start earning money. For that, you want to be a bit growth focused. And when I say growth focused, it also means a little more riskier option than putting money in a bank account, which means investing in stocks and mutual funds. All right. So, for your long term goals, you have to invest money. For your short term goals, please put your money in banks and FDs and RDs. Okay. Okay, we'll get into, yeah. So bank options. Uh, all accounts will give you some compound interest, and it's different for different types of deposits, right? If you have a fixed deposit and you say it is a long term, like a 3 to 5 year fixed deposit, will give you a higher interest rate. If it's just for 1 year, it will give you a lower interest rate. But this is guaranteed. Like at the end of 1 year, suppose these are just a range of rates that I've put here. Uh, for example, what's Arya got that 1 lakh. Arya decides, I'm going to just put it in a fixed deposit and not touch it. And in 1 year, that will have earned her some amount of interest, right? That's what you do when you get a lump sum investment money. You get a big chunk of money and you say, what do I do with this? I have no idea. Okay, let me put it in an FD. All right, that's one way of looking at it. A savings account is basically gives you very little interest, better than zero, but it gives you very little interest. It's almost as good as having cash, but it's safer in a bank. So you put it away in a bank and it's fine. A recurring deposit is basically you decide every month, I want to put aside 1,000 rupees for my vacation or for my emergency fund, whatever the goal is. So you say, okay, I'm going to make regular contributions over the next year and a half or whatever time period, and that will earn me an interest. All right. These are your bank options. These are safe, no risk options. All right. Oops. Sorry. Government schemes. There are some government schemes that parents of girl children can do. There's Kisan Vikas Patra, all these schemes, senior citizen scheme. Maybe you want to do it for your grandparents. It doesn't mean that they have to put the money. You can put money on their behalf. A national savings certificate. So these government options also give us a pretty decent interest rate, but they also have a high tenure, right? They're like 5 years, 115 months, 21 years, 5 plus 3 years. So this is money that you want to put aside and not think about. You don't really need it till, it's like almost an emergency situation. So you put this money aside and you forget it. Yeah. These are some government options. You can get it in government approved banks and post offices. All right. Now, we're going to talk about inflation a little bit. All right. So, what is inflation? Basically, that is when over a period of time, the price of goods increases, right? Like whatever the price of something was today, it is most likely that it will be higher 5 years from now. That thing will become more expensive in 5 years. All right. as of March 2025, India's inflation rate was 3.34% annually. And this is actually a very, very good inflation rate. It is not terrible. Okay. This is something to be proud of, actually. All right. But now, here's the time for a poll. Now, I want you to sit in a time machine, go back to the year 1964. Okay. And you have 100 rupees. Please guess how much rice you could buy with this 100 rupees. You're not today, you're back in 1964, and you have 100 rupees, and I want you to go buy rice. Can you make a guess on how much rice you can buy with this money? Please use the poll. There's 71 kgs, 109, 142, 167. All right. Let's just wait for a few more and then we'll stop. So you guys are split between the 109 and 142 kgs. That's neck and neck. I want one of those to become higher. That's a big clue. All right. Yes, you guys are almost right. The guys and girls who voted for 142 kgs, that is right. All right. So this is going back to like mandi prices in 1964. For 100 rupees, you could have bought 142 kgs of rice. Now, although we don't have a poll, if you have any idea how much rice can you buy today with the 100 rupees, keep that in mind. And I'm going to show you this graph. Today, mandi prices will give us about 2 kilos, 2.15 kgs of rice. So as you can see, this little wonderful chart, from 1964, the price per kg was 70 paise. Now it's like, this is again not the top quality rice, not the worst quality rice, 46 rupees per kg. This is how much rice costs us now. All right. This is exactly what we're talking about, inflation. This is how the price of rice has gone up. Okay. Now, I want you to think about this. The same 100 rupees, your grandparents, or maybe if you're very young, your great grandparents had the 100 rupees. In their mind, they're thinking, my God, I am giving my grandchild 142 kgs worth of money, right? A kgs rice worth of money. But let's say one of your grandparents decides to invest this 100 rupees in 1964 in the Bombay Stock Exchange. And then in 65, 66, 67, 68, for the next 10 years, 100 rupees. So the total investment they put in your name was 1,000 rupees. All right. Now, today you were cleaning up your grandparents' house. You found the stock certificates and you said, oh my God, I wonder how much this investment is worth today. Can we see a poll and get an idea of what you think that 1,000 rupees invested over 10 years? And then they stopped. They've not been investing. They stopped in 1974. That's it. That 1,000 rupees was invested. How much do you think that 1,000 rupees has become today if it was invested in the market from 1964? Question number 6. Please poll. Do you think it's about 16,000 rupees? Is it 63,000? Is it 6 lakhs, 66 lakhs? How much? Very good. All right. Any more? Yeah, so 50% of you are correct. That 1,000 rupees is now worth 6,36,000. I'm sorry to disappoint the few who chose 66 lakhs. I'm sorry, investments are good, but not that good, all right? So this is a graph of how the investment grew from 1964, 65, and then slowly, if you can see this like an if you tilt it, it's like your investment has grown all the way to 6,36,000 in this 61 years, right? And we didn't even take like major returns. We just said 12% per annum return, and that amount would be about 6,36,000 today. That is significant for from 1,000 to that much is a lot, all right? So the point of telling you all this is to get you excited about investing. In this chart, you can see the orange line is how our grocery prices are increasing with time. All right. So 1,000 rupees in the year 2000 would bring us this much of grocery, and the same money, actually now that same amount of grocery would cost us 3,700 in today's terms. All right. What I want you to note is this purple line. I know it's going up and down, but the general trajectory is upwards. All right. So this reflects 1,000 rupees invested in Nifty, which I will get to later in the year 2000. And by 2025, that 1,000 rupees had become 16,850. All right. Don't go into the actual amount. What I want you to focus is on this gap between the orange and the purple line. What we want to do is to make sure our investment is growing much better than the rate of inflation. Like our inflation is here, at least our investments, there's a big gap. At least our investments are doing so much better that we don't have to worry about inflation. That is the goal of investing. Your goal of investing is to grow your money to beat inflation. You get it? So the whole story about the rice and the investment is to show you that you need to invest money to beat inflation. Okay, and how does one invest money? You can invest in stocks, bonds, mutual funds, exchange traded funds being 4 assets that we are going to talk about today. There's, of course, many more, but we'll stick to these. And the first one is stocks. So basically, as you all know, a stock represents ownership of a company. I own a company and I want to raise more money. So I say, okay, I will sell a fraction of my company to you, to A, B, and C, to Arya. I will sell some. And when you buy this stock, you become part owner of my company. All right. I would recommend you invest in stocks only and if and only if you have a very good understanding of financial markets. I mean, individual stocks. Like if you know, oh my God, I know I have spent so much time researching these companies. I know exactly what this company is going to do in the future, right? If you think and you're so confident in your research, then please go ahead and invest in individual stocks. Okay. But otherwise, I would not recommend investing in individual stocks. We will invest in stocks, but through mutual funds, all right? Just coming up. And please do not do day trading. What day trading does is remember that purple graph of your money growing over years and years and years. It puts a break to it. You've bought it, you've sold it. You've bought more, you've sold more. So please, no day trading. At the end of the day, if people think, oh, I made so much money in this trade. In the long run, having kept that money in the stock would have also gained that much returns. So please, day trading is leave it to people who actually do it for a living, not for you and me. All right. Here are some examples of the top stocks in India: Reliance Industries, HDFC, Bharti Airtel, TCS. And these are based on market cap. Market cap basically is the stock price multiplied by the number of stocks outstanding in the market. So this Reliance Industries, and this sort of gives you an idea of the worth of the company. Like, oh, wow, Reliance is worth 19 trillion rupees. HDFC is 14.82 trillion rupees. And this is based off of today's stock price, right? Like today, the stock price was this at the time I made my presentation, and this is the market cap today. It may go down, up, who knows? Bharti Airtel and TCS are very close. This can go up and down. They may become third and fourth. It may change. All right. And stocks in India are traded in both major stock exchanges, the Bombay Stock Exchange and the National Stock Exchange. All right. Second, you can invest in bonds. What are bonds? So bonds are basically issued by either the government, it could be state government, central government, or corporations when they want to raise money. They're basically asking for a loan. They're asking you and me for a loan, right? They're not offering ownership like a stock does. When you buy a bond, you don't get ownership, but you're actually just giving them a loan. And anytime you give a loan, you will also charge interest, correct? That is what this coupon rate is. If you see in the graph in the box below, that's the interest rate that government agency or that corporation is willing to pay you for having given them the loan. So at the end of this investing period, you will get back your principal amount and you will get this interest. So this is like a guaranteed return. Okay. And bonds are rated from AAA, AAA to AA, to D. And D stands for default. That means you expect this company to go into default, or they will not be able to return this investment that you're making. But the interesting thing is, as these bonds go from AAA all the way to D, the interest that they offer also goes up, because they know that if I'm very good and the chances of me returning this money is high, then I don't need to be giving such a high interest rate. So a AAA is, for example, 9.65 coupon rate, but a triple B is giving you 16% coupon rate. You get it? And a D will give you even higher, but that's a very risky investment. All right. AAA is highest safety and lowest risk. And as you go down, D is the chance of default is very high. So bonds are a safe bet. All right. Especially if you're investing in AAA, etc. Okay. Let's go to mutual funds. My favorite. Okay. So what's a mutual fund? Mutual fund is an investment which has a slice of a whole bunch of different assets. So let's say I have a mutual fund which has a little bit of all the top 20 companies in India, like we saw in the first, in the stocks, right? Reliance, HDFC, Bharti Airtel, TCS, them and the next six. It gives me a little bit of these top companies. All right. So I am not investing in only Reliance. I'm not investing in only TCS, but as in the form of a mutual fund, I'm getting a chance to invest in all these top 10 companies in India. All right. So when I buy a share of a mutual fund, I get a little bit of each of these stocks. So my risk is reduced in case Reliance doesn't do very well, or just because our tariffs went up thanks to Donald Trump. Reliance Industries, the petrochemical, is not doing well. Oh, their stock price is going down. But hey, it doesn't affect Bharti Airtel. Okay, Bharti Airtel is still doing well. So when you buy a mutual fund, if one of your stocks is not performing well, it gets adjusted by the performance of other stocks. In case the market itself is bad, then everything will go down. In which case, even if you invested in individual stocks or mutual funds, everything would be going down. But in case of a regular market, some may go up, some may go down. Eventually, your risk of losing money or your opportunity to make a return is higher when you invest in mutual funds. So how does a mutual fund work? Let's say I am the asset management company. Yeah, I'm the fund manager, so to speak. Okay, I'm the one who's going to choose which companies will make up my mutual fund. Okay, great. I go to the investors and I say, hey, give me your money. I will take your money and I will invest in it. And whatever returns I get, I will share it with you. And for doing all this work, I will take a little bit of money. That's how mutual funds make money. They're not doing it for seva. They're going to do all this effort to make some fees, right? That is the fund management fee. So that's everybody charges it, so not a big deal. All right. So you can invest, and every when you invest in a fund, you will be given a folio number, and you will track all your investments. Okay. You can invest in mutual funds through what is very commonly known as SIP. It's no big deal. It is basically you decide, oh, every month I am going to invest 1,000 rupees in this mutual fund, or in these three mutual funds I will put 500, 500, 1,000, whatever it is. And that just goes. You can put it on an auto payment from your bank, etc. And this way, what happens is every month you're putting a little bit of money into your investment, and every small amount will eventually grow and become a biggish amount, right? So instead of making one huge payment into a mutual fund, you're doing it over a period of time. It results in higher return, because you may have bought the mutual fund when it was cheap, but then it's doing well, so the mutual fund price has gone up, but then you're taking advantage of it because you bought it when it was cheap. So SIP is a method of investing in funds where you choose a scheme and you put a certain amount every month, or you can even make it every 2 weeks, every 3 months. It's really up to you. That interval in which you invest is really up to you. There are many ways to categorize mutual funds. Okay. First way of categorizing them is according to the assets. Now, when I say asset, I mean, is the mutual fund made up of different types of bonds, AAA, triple B, triple C, D, different types of bonds, or all AAA bonds? Then that will be called a debt fund. If it's made up of bonds, an example is Axis Corporate Debt Fund. Okay, so this is a corporate bond fund. A bunch of corporates must have put out a request for bonds, and then they mixed it up all together and made a debt fund out of it. Equity funds, as you can imagine, are made up of stocks, different stocks. The mutual fund is made up of only stocks, no bonds. And a hybrid fund is made up of a mixture of both. All right. So equity funds are a high risk, high return asset. A debt fund is a low risk, low return, because it's based on bonds. You know, a bond is going to give you X% rate, but a stock may go up or down. It is volatile. All right. And a hybrid is again between these two. Okay. So that's one way of categorizing mutual funds. The second way is, there's many ways. We'll not go into all, but these are the major ones, is your market cap. Okay, market capitalization. Again, this works only for equity funds. Why? Because market cap basically means your share price by the number of outstanding stocks in the market. So it's an investment in stock bonds, stock funds, right? Equity funds. So a large cap would be the top 100 companies. Okay, their market capitalization is above 50,000 crores. A mid cap mutual fund would be is made up of different companies which are between 15 to 50,000 crore market cap. And then small cap is below 15,000 crores. Or you can just see 100 to 250 at large, or 251st and beyond. Okay. Now, I want you to pay attention to the returns. And here again, you can see as you go into the small cap, your percentage return is higher. And why is that? It's because they are slightly more risky investments. The chances of a large cap let's say a Reliance or a TCS to fail, to go bankrupt is very low, right? So your returns are also, you're not taking that much risk. Hence, your returns are also limited. But with a small cap, oh, there's a chance that it might not make it, right? So hence they are willing to, you have a high risk, high return there. Okay. All right. Now, mutual funds can be classified by risk. Each mutual fund, uh, every asset management company, AMC, has to put this thing called riskometer. This beautiful diagram, I have not come up with it. SEBI has mandated it. So every time there's a mutual fund which is advertised, they have to say, is it a low risk, low to moderate, moderate, high? You have to tell the investor where my risk is. All right. So this is also it's up to you what you want to do with what your risk appetite is. Okay. The next way of mutual fund categorization is whether they are actively managed or whether they are passively managed. I recommend for most people who are starting off, in fact, I still do it, is to stick with passively managed funds. What does that mean? This means that the fund mirrors a market index. And now, what's an index? Let's say Nifty 50, right? Nifty 50, I'm sure you've heard, is the top 50 largest companies which are trading on National Stock Exchange. They're put together, and that is an index. So they will see how Nifty 50, all these 50, how Nifty 50 did today. Then Nifty next 50 is the 5200, 51 to 100. How did those do today, right? So what you're doing is, if a mutual fund invests in exact proportion as the Nifty 50 lies, right? This is commonly available information. Like everybody who wants can figure out what is the ratio of Nifty 50 companies in the Nifty 50. And if I exactly copy that index and I invest in it, there is no active stock picking. Like, I'm not going to be saying, oh, today I think Reliance is going to do poorly, so let me change the amount of Reliance in this. No, that happens in this actively managed funds. In actively managed funds, you are relying on a fund manager's knowledge, on his gyan to manage markets and to beat the market and this and that. If the market is doing well, then Nifty 50 will do well. Then Sensex will do well, right? So you invest in passively managed funds. These mirror a market index. If the market is doing well, your fund will do well. Whether I'm actively managing it or not, it's fine. I'm going to get decent returns no matter what. And this is also highly transparent. You know exactly what the weightage of each stock or each bond is, because you are exactly mirroring an index. Whereas in actively managed funds, you never know what the manager is doing. Aaj mood ye aaya, he will do whatever he wants or she wants, right? So my recommendation is to follow and invest in passively managed funds. Okay. That's it about mutual funds. Now, ETF, very briefly. Okay, another thing about mutual funds are not traded. Like, if you place a trade to buy or sell a mutual fund, all these transactions happen at the end of the day. It's not actively, not all during the day, right? They have all the transactions for mutual funds are completed at the end of the day. Whereas stocks and ETFs, you can buy and sell during the day. Whenever they are being traded, you can buy and sell ETFs and stocks throughout the day on a stock exchange or yeah. So what is an ETF? ETF is now also like a mutual fund, but the only difference is that they can be traded throughout the day. They also put together stocks, bonds, commodities, currencies. They'll put it and make a basket out of it. They'll give it a name and it will get its own ticker, like Reliance is RIL. This ETF will be, let's say, Preeti's ticker, PIL. And I will trade it on the fund, and you choose and buy and sell it, and it will go up, down. It's up to you whether you want to buy ETF or mutual fund. It's totally up to you. There are many types of ETFs. Equity ETFs, as you can imagine, they trade stock indexes. Debt ETFs, they invest in government bonds, corporate bonds. Commodity ETFs, this is gold, silver, oil. So a gold ETF is a good way of investing in gold. A lot of people ask whether it's good to invest in physical gold. It's good as long as you can safeguard that gold, if it's in a locker and you know that nobody's going to get to it, because physical gold, whoever owns it, whoever has it in their hand, it belongs to them, right? But a gold ETF is in your name. This allows you to follow the how gold prices are moving without actually having the risk of having actual gold in your locker, in your house, etc. All right. Some of the students had asked me last year how to invest in international stocks, etc. So one way to do it was to make a brokerage account with an international broker like Charles Schwab or someone. That may require a whole bunch of paperwork. The other simpler way is to buy international ETFs. This provides you exposure to global indexes. Like we have our Sensex and Nifty. In the same way, there's like the NASDAQ 100 ETF, the NYC FANG Plus ETF. So there's different ways to, you can track, you can invest in them and get exposure to the global stock market as well. Okay, so that's about ETFs. Now, how does one get started? Sorry, it's getting very late, but this is important. So for when you want to invest in stocks, bonds, and ETF, you need to open a demat account. Please note that I did not say mutual funds here. You do not require a demat. It's okay, you can, but you do not require a demat account for that. So for stocks, bonds, and ETFs, you open a demat account, and whoever opens that demat account will also open a trading account for you. What is a demat account? It really means that it's a place where they're writing down. Earlier, stocks and bonds used to, when you bought it, you actually got a paper which had your name and it said you own these many stocks. Now it has been dematerialized, basically digitized. So that stock is now in your name, but it's just in that account. It will be listed there. That's all it means. Not a big deal, like, wow, demat account. It's nothing. It's just a list of all the shares in electronic form. Okay. And any brokerage house can open it. I recommend using discount brokers like Zerodha, Grow, Upstocks, because they have low brokerage fees. So they may have like one flat fee per trade. Whereas if you go to a full service broker, which basically will help you buy and sell stocks, bonds, etc., but they insist on giving you gyan, for which they will charge you more fees. Okay, so they may charge you a percentage of your trade value, which is why you don't want to give them money unnecessarily. So for most people, these discount brokers work well. If you suddenly become rich, you have crores and crores and crores and like unlimited amount of money, and you really need advice, then please go ahead with any of these full service brokers. Okay. Now, for mutual funds, you can actually go directly to the mutual fund website. You can click, you can buy it as if you were buying something off of Amazon. It's that simple. Or you can use your broker to invest in this. Broker, again, is any of these, Zerodha, Grow, Upstocks, any of these. Also on their website, you can go and invest in a mutual fund. The only thing I want you to remember in mutual fund is, if there's an option of using direct plan, please choose that and not regular plan. A direct plan helps you save money, which is called distribution commission. If you buy uh, if you buy through a regular plan, you end up paying extra. In addition to the mutual fund fees, you pay this extra distribution commission. So no, always invest and make sure you check direct plan when you're buying mutual funds. Okay. Investment tips. Yay. So remember, for long-term goals, like I had said earlier, you must invest money. For short-term goals, save it. Um, for long-term goals, like let's say you want to buy a house 20 years down the road or 15 years down the road. So you have a long period where in which you can invest. So you can take risks. So you can invest in equity mutual funds. These are slightly riskier than your bond mutual funds, right? Or hybrid, but you have better returns. Also, you're giving it a long time horizon for the risk to go up, down, up, down, up, down, but that eventually that graph will be higher. For short term goals, you can just put money aside in savings account or FDs or in bond funds where you also know you are going to get this certain coupon rate or this much money you're going to guaranteed get. Okay. Again, mutual funds, please use direct plan, not regular, direct. Okay. And look at passive mutual funds, not the actively managed funds where you're relying on one fund manager's buddhi versus passive investing where you are mirroring a market index, okay, like a Nifty 50 index or whatever it is, okay. And most of your investment in mutual funds should be again in this wonderful ratio 50 30 20, large cap, medium cap, and small cap. Okay, so minimize your risk, but keep some exposure so that, oh, in case that 20% of small caps do well, you make money. But your large, most of your investments are solid, like you will get a good 12% return or something, which is great. All right. And always remember this, not everybody's risk profile is the same. Know your risk profile before investing. Okay. I will rush through insurance and debt. Okay. What's insurance? My any type of risk in my life, let's say I fall sick, I die, my house burns down, I have a car accident, all any kind of these horrible events that can happen to me, I minimize the negative financial impact of that on myself by buying insurance. All right. So, medical insurance for the family, life insurance in case I die, automobile insurance in case I meet with an accident with my car, etc., or my motorcycle. There are two main general categories of insurance. First is general insurance, which is healthcare, very self-explanatory. It's for your medical health expenses, like you go to Manipal or Columbia Asia or Vaidehi or whichever hospital, and there instead of you paying so much money out of pocket, your insurance will cover it. Automobile insurance, homeowners insurance, like you want to safeguard it from fire, from flood, whatever it may be. The next type of insurance is life insurance. And this is what we're going to focus on today. And please ignore everything in white. Don't look at anything other than this thing called term life insurance. What is life insurance? What it means is that for example, I am the earning member of my family. If I die, then my family depends on my income. But once I'm dead, there is no income. What happens in that case? If I have bought some form of term life insurance, then my family will get either a lump sum amount, which is significant, which will help them manage their expenses in the future. Or if I don't buy, then they are going to be at a loss. So, one second now. Oops. Yeah. Term life insurance usually comes with the lowest premium and gives the highest coverage. Okay. Whole life endowment plan, ULIP. Oh my God, you will hear so many people trying to sell you ULIP. Oh, what all these other plans are, money back plan. All the insurance companies got bored one day. They said, Array, we are only selling this life insurance. Let's make it exciting. Whole life. Let's say if somebody lives to 100, then we'll give them a very big bonus. If I'm 100 years old, what will I do with that bonus, right? So please stop and think. Endowment plan, you're going to get savings component in this and also life coverage. I can save money in an FD, in a bank, in a any other form. I don't have to buy insurance. So all these other products, and ULIP is the best. They say we'll take your money and invest in the market for you. I don't have to mix my investment and insurance. Okay. So anytime you want to consider buying life insurance, for example, if you're the only earning member and maybe you want to buy it for your parents because they depend on you, then please just buy term life insurance. This is just the pure protection of insurance without all these other wonderful things of investment, etc. You have to make the distinction between insurance needs and investment needs. For investment, you have stocks, bonds, mutual funds. Please invest in that. Please invest in real estate. For insurance, for life insurance especially, just buy term life insurance. Okay. And even in that, get into the details. Don't buy too much money because your premium will be high. Don't buy too little protection because what is the point? You're dead and now your parents are left with very little money. So you have to think about details. But first and foremost, do not buy any other kind of insurance for life insurance. Understand? For life insurance, buy term life insurance. Okay. Debt and repayment. Really quickly, what is debt? All it is loans, right? But not all loans are bad. In our mind, somehow we think, oh, he has a loan, oh, it's so sad and bad. No, not really. If I've taken an education loan and I think that by taking this loan and going and doing an MBA, I am increasing my chances of doing better or increasing my net worth in the future, it is a good debt, right? If I'm taking a loan to buy a house, then I am putting money, saving money, paying that mortgage, that loan, home loan, and eventually I will have a big asset. So you have to think about loans. Am I taking this loan and is it an investment in my future? Is it giving me a potential to increase my net worth? Then yes, go for it. But a bad debt is like a credit card debt on like a fancy phone or a TV, or an impulse purchase, or a personal loan for some vacation because you wanted to show off to your friends. These are horrible debts. They don't provide a return on your investment, and typically the asset is going to reduce. It's a depreciating asset, whereas a house, for example, its value will go up. Okay, I have put auto loan in here. I know that as soon as you buy a car or a motorcycle, it depreciates. But if you're using the car or the motorcycle to help you generate income, then it is worth it. Okay, so not all debt is equal. Good debt, bad debt. But anytime you're going to get a loan from anywhere, please borrow only what you need. No need to borrow extra, because the guy who's giving you the loan will say, sir, you are approved, ma'am, you are approved for 10 lakhs. You only need 3. Please don't take the extra 7. Okay. Compare interest rates from different lenders, and also make sure this tenure is, how long is the time in which I have to return this? Is it a 5-year loan, a 10-year loan, a 30-year loan? Make sure you remember that. Please look at this graph, and the dark brown stuff, the 168, the 128, 91, this is the interest payment on the solid yellow principal. The principal is the same, but if I'm repaying the loan in 10 years, I'm paying so much less interest overall. If I'm taking 25 years to pay the same loan, I'm ending up paying so much more interest, almost like double of the principal amount. So please make sure whatever tenure you have, you know that your interest is going to be very high in the long term loans. And maintain a good credit history. Whenever you apply for a loan, the first thing a banker or any agency, NBFC, will look at is your credit score. This only reflects the probability of you repaying your loan. If you've been very good with paying your credit cards on time, your electricity bill, there's nobody who's saying, this person has not been paying things on time, then your credit score is higher. Okay, you can check your credit score on these bureaus. But when you apply for a loan, uh, be careful not to apply in multiple places, because every place you apply for a loan will go and check your credit score. And if anybody other than you is checking your credit score, then that negatively affects your credit score. Okay. So if you just want to get an idea of what interest rate they're offering the loan on, call them, get on an email with them, but don't allow them to go and check your credit score. That usually happens when you sign off an application. If you don't sign off an application, nobody has the authority to go and check your credit score. Okay. Make sure you have a decent payment history. And if the longer your credit history, the better your credit score will be. Okay. And it just had like 2 or 3 when you want to repay your debts, please try to repay them as soon as possible. Let's say you have different types of loans. You have a credit card loan, education loan, personal loan, and you bought a TV also on a loan, like on your credit card. It was a special credit card you could apply for, and you got this. You have to look at the interest rate. Please make the minimum monthly payments, but any extra amount that you have, quickly pay off your loans. There's 2 strategies that people use. You can look at the amounts here and the interest here. This credit card loan has the highest interest rate. So one strategy is to pay off any loan which has a very high interest rate. Pay that off first. Make minimum payments for all. Any excess amount, pay off that high interest loan. The other strategy is pay off the largest amount first, right? Oh no, I'm sorry, the smallest amount first. That way you'll feel like, oh wow, I made a payment, and look, I'm already done with one loan. I now have to focus on only 3. The smallest payment, 15,000 rupees, you pay that off, right? So the idea is you want to be debt free as soon as possible. Please try not to have debt that's sitting on your shoulders and weighing you down. All right. Avoid debt. Start investing early so that you can take advantage of this compound interest. Achieve long-term goals by investing, and good luck. That's it. I will stop sharing. If there are any questions, I'll take them now for 5 minutes. I don't want to take too much of your time. Should I open the Q&A here?
Yeah, so Ms. Preeti, do you want me to take up some of the relevant questions we have received?
Yeah, sure.
Yeah,
Yeah, it's right here. I see some of them here. Should I go ahead?
Yeah, sure. No
Yeah.
worries.
Considering options like SIP, mutual funds, fixed deposit, real estate, gold, which investment is better in today's market, and how should one decide based on risk, return, and financial goals? Shashwat, that is a very good question, and it's a very personal question. What is your risk profile? Just like that giraffe, your risk profile may be very high. You have a lot of money available, and your financial goals are very long term. In case they're very long term, please invest in mutual funds. In case they're very short term, please invest in your FDs or something like that. This is a question that everybody needs to answer for themselves. Okay. Gold, again, I don't recommend buying gold. Although we are a country which loves gold, what I would say is invest in gold ETF. They are secure. They follow the growth in gold prices. If it's going high, it will go high with that. So that's my recommendation for you. Anonymous attendee, if I earn 1.2 lakh per month in Bangalore, is it financially wise to take a home loan with EMI of 50 to 60K for a house or flat, or to continue living in a rented house paying 30 to 40K? How should one evaluate this decision in terms of long-term wealth, liquidity, and financial stability? Okay, so my question to you is, if you take an EMI of 50 to 60K, you are going to be left with 60K. Is that enough for your other needs? I know that's you've bought a house, so I'm hoping you are going to stay in that house, and you're not going to continue living in a rented flat, right? So if you have moved into that new apartment or house, then let's assume that this 30-40K which you were paying for your rent, it has increased, but at least you are making an investment in your own self. Now, what I want you to answer for yourself is that remaining 60K, is it enough for you to spend on your utility bill, your phone bill, any emergencies that you may have? Have you invested enough for your future? If the answer to that is yes, then absolutely go for it. But don't do it unless you have some of the other basics taken care of. You have enough of a cushion in case you lose a job and then you cannot pay this EMI. So make sure you have a good solid base, and then I would highly recommend you go for it. All right. How can we invest in SIP as a beginner? Please go to any of these websites. Zerodha, Upstocks, Grow, GROWW. There they have these plans and you can set it up quite simply. So it is quite easy. Just go to any of these websites, and SIP again is only systematic investment plan. It's a way to put 500 rupees per week into the stock market or into mutual funds. Yeah. So don't think of it as any big process. So Gopika, how can we save or invest our income as a fresher? This whole presentation was about how you can save and invest. Use bank if you're depending on your risk profile. If you want to save for short term, use banks. If you want to invest for the future, please invest in the market. If a person's base salary is 15 lakhs per annum, how can they get tax relaxation? What are the possible ways to reduce their tax liability? Okay, so as you know, actually for salaried person, the amount is almost 12.5 lakhs per annum, for which you don't have to pay tax. Your tax liability is zero. So what you are actually worrying about is that extra 3 lakhs. Now you can, please go online and search or ask Chat GPT to make you a chart which says how much should my deductions be for me to get a better tax. You have to pay tax either with the old or new regime. The only way you can reduce your tax liability is by putting away money in through deductions, right? So go and check what your deduction amount should be, and if that helps you, then go with the old regime. Otherwise, stick with the new regime. It is not that terrible. Okay, suppose a person, I'm sorry if I have not answered your question fully, but let me just go through the rest. Suppose a person has low salary but high EMIs every month. How should they manage their finances? Okay, EMI actually reflects loans or credit card bills or something like that. So, what your job is right now to minimize all your other expenses. Your only purpose, sole focus, your financial goal in the short term should be to just repay this. And the two strategies that I suggested: first, please repay off your more expensive interest rate loan. That way, the amount of interest you pay over the long term will be reduced. And if that doesn't work, if that is a very big amount and you want to feel good, like, oh my God, I finally repaid one loan, then pay off your smaller EMIs. But the goal is, I know if you have a small income, it becomes tough. But in the meantime, don't worry about saving and investing for the future. Become debt free, and then you can worry about the other stuff. For long term, which best SIP to invest? So again, SIP is just a method of investing. It is not the name of a mutual fund or a stock pick. So it's just a method. So again, go to Grow and Upstocks. Please read. Depending on your risk profile, choose your product. Can an employee get the retirement money if he wants and if he retires early? 10 to 15 years early from retirement age. EPF, if this is what you mean by EPF, EPF will be paid to you only after your retirement age. You have to wait. If you take it early, I don't think it is possible to take it early also. So can you just go back to that question if it's possible, or it's gone? Answered. 1 second, let me go back here. Suppose a person, no, sorry. Okay, fine. All right, sorry. Which one is better for investment, mutual fund or SIP? Okay, again, SIP is just a method of investing in mutual funds. It's a way to discipline yourself as an investor, saying, as I will systematically invest, systematically investment plan. So I will systematically invest 1,000 rupees in this mutual fund, 1,000 rupees in this mutual fund. So there is no comparison between a method and the product. So you are going to invest in a mutual fund through SIP. Okay. I hope that's clear. Any other questions? That's it. I think I will let people go. I have reduced the number of attendees from 100 plus to 70. Thank you so much for being so patient. I'm sorry for the technical problems initially, and this session has gone for 2 hours. I will let you all go and eat your dinner now. All right.
Not a concern, Miss Preeti. And yeah, thank you so
Thank
much.
you so much.
Yeah, with this, we have come to the end of the session. And
Yeah.
thank you again for such a wonderful and powerful impact you have created in our
Oh, please.
scholars about
No,
the
no, no.
financial literacy. And we definitely appreciate the time and expertise you have shared. And we are
Thank
really excited for the learning that lies ahead. Yeah,
Thank you so much. Thank you, everyone who stayed on till the end and everyone who attended. And thanks for participating in all the polls. I hope you got something out of it.
yeah,
All the
thank you. Thanks
best.
a lot, scholars, obviously, yeah, for making
Yeah.
us more engaged. Thank you,
All
Preeti.
right.
Have a
Thank you
great
so
day.
much.
Thank you. Bye.
Bye.